Okay, so now the third and the last video of this chapter, we learned that there were two methods to revalue the assets and liability. In the first method, the revised value were to be recorded in the books. So we prepared revaluation account for that. Now let us do the second method. In this method, we do not record the revised value in the books of account. In such case, no revaluation account is prepared. We only pass a single adjustment journal entry for this. Let's understand the steps of it now. In the step 1, you will calculate the net effect of revaluation. Just like we were doing in the account that all the happy things were being credited, here all the happy things will be added. Any increase in the asset or decrease in liability will be added. And all the sad things, all that was debited in the account will now be subtracted. Less decrease in asset and increase in liability. And you will find out the net effect of revaluation. That is profit or loss. If it is profit, the net effect will be positive. If there is a loss, the net effect will be negative. In such question, if you prepare revaluation account, you will get a straight 0. So whenever it is written that the revised value are not to be recorded, we do not prepare revaluation account. We only calculate it in this manner. The second step is to calculate gain and sacrifice of the partners, just like you were doing in previous classes by calculating sacrificing ratio, old ratio minus new ratio. In the third step, you will calculate the share of the gain or sacrifice in the net effect that we calculated in step 1. So the gaining partner will equal to net effect into share gained, and the sacrificing partner will equal to net effect into share sacrificed. In the last step, we will pass an adjustment journal entry. If the net effect is positive, that is, there is a case of profit on revaluation, then the journal entry will be gaining partner's capital account debit to sacrificing partner's capital account. The gaining partner will compensate the sacrificing partner the amount of profit on revaluation. And if there is any loss, the net effect is negative, the journal entry will be reversed. Sacrificing partner account debit to gaining partner's capital account. Now you can observe that when the net effect is positive, the journal entry gaining partner's capital debit to sacrificing partner's capital is similar to the journal entry we do for goodwill also. So if in the question the revised value of assets and liabilities is also given and the goodwill is also mentioned and it is written that the revised value are not to be recorded, instead of passing two different journal entries for revised value gaining partner's capital to sacrificing partner and also for treatment of goodwill gaining partner debit to sacrificing partner, we can record a single compound journal entry for it. For recording such a compound journal entry, when we do the step 1, when we calculate the net effect, in that other than the revised value of asset and liability, we also add goodwill to it. Let's solve a question for more clarity of this concept. Following is the balance sheet of A and B who share profits in the ratio 3:2. On the asset side, cash in hand, debtor, stock, building, plant and machinery given. And on the liability side, bill payable, creditor, general reserve, capital of A and B are given. From April 1, partners decide to share profits and losses in the ratio 2:1. This is the new ratio. And adjustments are given for revised value of asset and liability, and also fourth adjustment is of goodwill. Goodwill of the firm be revalued at 90,000. Then it is mentioned that we have to record the journal entry if partners do not want to show the revised value of asset and liability in the books. Hence, this is case 2 of revaluation of asset and liability. We have to prepare then partners capital account also and balance sheet also. Let's start the solution. In the step 1, we find out the net effect. In this question, goodwill is also given in the adjustment and the revised value of the asset and liability is also given. So first we add goodwill. Goodwill is mentioned 90,000 rupees. Next it is written that creditors amounted to rupees 3,000 are no longer to be paid. So your liability decreases, it will be added as it is a benefit. That is, all the happy things that we recorded on the credit side of the revaluation account are being added here. So decrease in creditor is a benefit, hence added rupees 3,000. Next, it is written that building is to be revalued at rupees 1,20,000. In the balance sheet, the value of building is 80,000 and now it is to be recorded at 1,20,000. So what is the increase in building? 40,000. It is a benefit, so it will be added. Next, it is written that a provision of 10% is to be made on debtor. Making provision is a charge against profit. Hence, it is a sad thing for the business that we were recording on the debit side of the account. Now it will be subtracted. So 13,000 rupees subtracted. What is the net effect of revaluation in goodwill now? Rupees 1,20,000. We can observe that the net effect is positive. Now the step 2 was to calculate gain and sacrifice of the partner by using the sacrificing ratio. So old share of A and B were 3/5, 2/5 since the ratio was 3:2. New share is also given to us 2/3 and 1/3 respectively. Now quickly calculate the gain and sacrifice of A and B. We can see that A is gaining 1/15th share and B will be sacrificing 1/15th share. And also we know that the net effect was positive. So what is the journal entry that we will record now? Gaining partner capital account debit to sacrificing partner capital account. Let us first calculate the gain and sacrifice in net effect. So we can see that A will compensate rupees 8,000 and B will get rupees 8,000 since he is a sacrificing partner. Let's pass the adjustment entry now. It was gaining partner debit to sacrificing partner. So in this case, A's capital account debit to B's capital account. And what is the amount that A will compensate to B? 8,000 rupees. If you're not able to understand this or any part in this concept, just watch the video again and practice this question yourself. Now, coming back to the question, we have passed a compound journal entry for goodwill and revaluation, that is revised value of asset and liability. Hence, we have treated the two things. Now, what is left in the question? In the balance sheet, there was a general reserve given. What was the amount of general reserve? 60,000. So, how do we treat this general reserve? We distribute the general reserve among the old partners in the old ratio. So, general reserve is distributed among A and B in their old ratio. Let's prepare partners capital account now. The first thing we write is balance BD on the credit side. Quickly see from the balance sheet what is the amount of partners capital A and B. A 2 lakh, B 1 lakh. Next, we will post the journal entries into partners capital account. What is the first journal entry that we did? It was for goodwill and revaluation. Let us post it now. After that, we recorded a journal entry for general reserve. Let us post it also. Partner will get general reserve. So it will be credited in the partner's capital account. Since nothing else is mentioned in the question, in the last step, we will calculate the balance carry down of A and B. Let's prepare the balance sheet of the new firm now as at April 1st, 2019. Now, this case was that the revised value of asset and liability are not to be recorded in the books. So, whatever value increased or decreased in the case of asset and liability, while we prepare the new balance sheet, it will not be recorded. So, the building was 80,000 in the old balance sheet. Despite of the fact that its value increased to rupees 1,20,000, we will record it at the old value only, since the case says the revised values are not to be recorded in the books of account. This is why we did not prepare revaluation account. Similarly, all the assets and liabilities are recorded at their old value only. 2 points that you need to remember here. General reserve will not be written in the balance sheet since it is distributed among the partners and it is finished now. We don't have any reserve left. And also, while we write the capital of A and B, we will record the new value of the capital now. That is the balance CD from the partner's capital account. Do this question yourself and then move on to the next concept that we are going to discuss now. In the previous question, we calculated the consolidated or accumulated net effect of goodwill and revised value of asset and liability. Now, for example, if in the question it is written that reserves are not to be distributed or accumulated profits and losses are not to be distributed among the partners. We have already covered this case in Monday's class. I hope you have practiced and brushed up your concepts. In such a case, when accumulated profits and losses are not to be distributed, then we pass an adjustment entry of gaining partner's capital account debit to sacrificing partner's capital account. In such scenario, instead of passing 3 separate journal entries of goodwill, revaluation and accumulated profit or losses or reserves, we can pass a single adjustment entry. For this, when we calculate the step 1 net effect in that, along with goodwill and the revised value of a certain liability, we also add reserves and accumulated profit, subtract any accumulated loss if they're like deferred revenue, expenditure, advertisement, suspense, etc., and find out the net effect of revaluation, goodwill and reserves. After that, all the steps are common. For example, in the same question that we discussed just now, let us modify it a little. Now it is written that the journal entries are to be recorded if partners do not want to show the revised value of a certain liabilities in the books and also do not want to distribute reserve. In such case, we will calculate the net effect of revaluation, goodwill and reserve now together. So general reserve of 60,000 added, goodwill added all the benefit of revised value, decrease in creditor, increase in building, subtracted the loss, provision for bad debt, and the net effect of revaluation, goodwill and reserve comes out to be rupees 1,80,000. After that, we will pass a single adjustment entry to record the net effect, that is gaining partners capital account debit to sacrificing partners capital account since the net effect is positive. So the net effect was rupees 1,80,000 and the gain and sacrifice share of A and B was 1/15. A was the gaining partner. So A will compensate how much to B now? 1/15 of the net effect, that is 1/15 of 1,80,000 rupees, which comes out to be 12,000. This is the journal entry that we will pass. Now in the similar manner, you will prepare partners capital account for this question and then the revised balance sheet. Just remember that here in the balance sheet, when you will prepare, it is mentioned that the revised value of assets are not recorded and also the general reserve is not distributed. So when you prepare the balance sheet of reconstituted firm on April 1, all the assets and liabilities will be same as it was given in old balance sheet, and also you will write reserve this time because the reserve are not distributed among the partner, and the capital account of the partners will be new, that is balance CD of the partner capital account. If there's any doubt in these concepts, feel free to ask, but before that, practice these questions at least twice yourself because self-study is very important. That's all for this chapter. Thank you.